The Federal Reserve has not even considered tapering until maybe up till now, or at least that's what it seems. Todd Bubba Horwitz of BubbaTrading.com is here to talk about all things Fed, monetary policy, gold, silver, the whole works, Todd. You are a man of many talents, and we're going to be talking about all these different things with you. Welcome back.
Great to be with you, David. I'm glad. It's always good to be on with Kitco.
Always good to have you. Now, I don't know if you followed the Fed meeting minutes yesterday, but it came out, and first of all, they released some disappointing outlooks in terms of the economy. Now, the focus here we want to talk about is tapering. Is this a possibility? Will they finally roll back on QE? What do you think?
Well, David, I think it's not only a possibility, I think it's a probability. We've already seen 10-year notes go from 0.25 to as high as almost 2%, and they've backed off a little bit, but still about 1.6. The bond market, which is the biggest market in the world by 10 times over every market combined, is telling the Fed that their rates are too cheap and that they need to start to hike. And the bond market can pressure the Fed. The other thing you're going to see here, if they don't do something, is, of course, inflation is getting bonkers. They won't admit to it, but when you're a surplus economy, you have to count at least energy if you don't want to count food. But have you seen the housing spikes and the cost of lumber and the cost of copper? So they've got to decide and finally slow this thing down, because you have too many people not working, yet too much money being lent out, which has to be tapered back. And of course, we've got so many of the elderly that would prefer to be in a safer spot for their investment, like a bank at 2 or 2.5%.
Okay. Now, all right. So this is a statement I want to read to you, like the comment on that. The minute said, various participants commented on the prolonged period of low interest rates and highly accommodative financial market conditions, and the possibility for these conditions to lead to reach for yield behavior that could raise financial stability risks. There's a lot of terminology here we have to break down. Reach for yield behavior. Are they referring to tapering? What is that?
Well, no, but what you have, one of the things that has propelled the stock market all these years has been the chase for yield. Unfortunately, many people depend on their investments to put them through and keep them over the top. And many, people save their whole lives to retire. They get either Social Security or their pension, and they want to get some type of yield because they want to continue the same lifestyle they had before. So what you've really done, David, is you've forced too many investors that don't want to be in stock markets or equity markets into them because of that ever chase for yield. And of course, all that really does at the end of the day is will cause a very big sell-off, which is why the Fed is trying to be overly careful here. But as we know from history, the more careful they try to be, the bigger the fall will happen when it does happen.
Mm-hmm. Now, here's another statement. A number of participants suggested that if the economy continued to make rapid progress forward toward the committee's goals, it might be appropriate at some point in upcoming meetings to begin discussing a plan for adjusting the pace of asset purchases. Let's break down their assumptions here. Is it true that the economy is moving forward at a rapid pace?
Well, I mean, you can make either side of that argument like a trade, okay? I mean, we're making a rapid movement. Why? Because we were closed for a year. So whatever growth we get is growth we haven't gotten. So you're getting a cumulative total of 12 months of rabid people wanting to get out and spend money. But you don't have jobs, or you don't have people going out to get the jobs that are available. So you've got the perfect makings for more of stagflation, which is high unemployment and high inflation, because the Fed policies are so antiquated. You could go back probably 100 years for the models that they are using right now. And it makes no sense that they refuse to admit to the inflation curve. And again, anybody who goes out to either buys a gasoline or eats or pays bills, they know that their costs are dramatically higher than they were. It doesn't matter how the Fed wants to equate it. They refuse to identify what real inflation is. And of course, when you go to the ivory tower, you lose your mind and lose all common sense of what is actually happening in the world. And that, I think, is the biggest problem.
Okay, let's talk about market reaction now. Gold rally a little bit, but it didn't hold on to its gains. How would you expect a safe haven asset like gold to respond to such statements?
Well,
Normally.
okay. Well, first of all, let's be clear. Gold is a great hard asset. I don't necessarily call it a safe haven.
All right,
It,
cool.
it could be a safe haven currency, but again, either way, listen. I'm an investor. I own gold. I buy gold, silver, and platinum all the time, physical, and I store it. But I think that gold and silver look terrific, and I don't expect much reaction. Remember, in today's world of active news and information flow, the fact that most of this stuff gets priced in well before it ever hits the tape. So I'm assuming that gold and silver had already priced in kind of what they were going to say, because if you look at enough of their information, you can kind of get a pretty good guess if you've got the right people looking at it. So, look, I think gold and silver are going a lot higher. I think that the action is actually perfect the way it is running, and it's just kind of stair stepping itself up, which is always better when you want to look for a longer term bull market. And I think that's what we're going to see.
All right, so again, how likely is it that they might, you said it's a possibility. How likely is it that they will actually raise rates? Because I mean, I've been talking to people. They're saying I'm getting mixed messages. Some people are saying zero. Some people like yourself are saying possibility. Prior to this year, they were talking about not raising rates until at least 2022, 23. What about this year? Could they change their tune?
Well, I think they're going to raise rates. I think they're going to be forced by the bond market to raise rates this year. I think that they're too far over their skis, and they're basically too clueless as to what is going on in the overall economy. And you've already seen the new talk of digital currency experimentation starting in the summer, which is really only another way for them to kind of pound up and build up the money supply, so the actual inflation numbers don't really show. You keep adding money through the tapering and through what they're doing, and adding funds, you're really creating an imaginary circle that does not exist. So I think what you're going to see is the bond markets are going to continue to push hard and force them to raise rates. And the banks have already started to hike a little bit. And I think that's going to be where we're going to be. And I would say I would probably make it a 60% chance that we see some sort of increase at the Fed funds rate this year.
All right. Let's great bold call. Let's follow up on that. Ted, let's talk about market reaction to this increase. What would happen to, let's start with the equity markets first. Are we going to see a repeat of taper tantrums, which is what we saw in 2013?
I think so. Look, first of all, I think we're probably reaching, if not already there, a peak in markets. Now, again, we can go higher, and I'm not going to say we won't, but it looks to me that they've kind of topped out here or peaked, and it doesn't mean they're going down tomorrow. But once the Fed starts to hike, I would use the 10-year notes. If they get over 2%, I would say you're going to see a nasty sell-off in equities, because all that money that does not want to be there is going to be gone. And I think that will be a very big deal when it does happen. Now, we haven't got there yet, but I do think that we are certainly headed lower. And I think we're going to be in store for a very nasty time in American history. But again, we've had them before. This won't be the first one when it does happen. We know it's going to happen. Now we're just waiting on the when. You
mean nastier than what we saw in 2020? That was pretty bad. Remember last year?
No, but that was very fast in 2020. Yeah. If you go back to 2008, okay, of course, we had a prolonged sell-off for about 6 or 7 months that was actually started long before they identified it. But I think you're going to see more of something like that. That is more of the typical real bear market, not the instant recovery in which we saw after COVID.
Now, on gold, Todd, you said earlier that you expect gold to go much higher, but wouldn't higher interest rates place pressure on gold, or is there another force that's going to push it up?
Well, I think, first of all, I believe that especially with the talk of digital currency, that will certainly help the precious metal if they ever start to really do it. I think that, again, markets are very efficient. And I think the gold markets, like every other market, already understands that there's a very good chance to see higher rates. I would make the argument to you that the reason we haven't gone up faster in gold and silver is that we've already seen that they've priced in higher interest rates already.
You've made an interesting point, Todd. Can you explain the relationship between gold and digital currencies?
Well, again, if we go digital, what that really does for the central banks around the globe, because we know China's already experimented with it, what it really does, it takes away your anonymity, because you no longer have the privacy of doing some things, even if you're like to go gamble, for example. Well, now, if you're digital, then basically the government can track you from the day you're born to the day you die. Okay. And most people don't want that. And I think that's, one of the safe havens of having a hard asset that is, negotiable and that can act as a currency, which is gold or silver or platinum, is a place where a lot of people will run to. And even some people that don't typically trade gold might start to look to buy there, because the thought of digital currency and the Fed taking even more control is very scary.
We've been at, and I'm just going to close this off here with the trading, we've been at the zero bound in terms of the Fed funds rate for a very long time. Many younger traders have not experienced interest rates higher than what we've seen now. Once we go above 0.25, 0.5, what's going to happen to the volatility of the markets? What will happen to the world of trading? Is there anything different that traders need to be accounting for at that point?
Well, I think you'll see more two-sided trading. I think you'll see more volatility in the market. Remember, we're trading at a very low volatility point right now. And part of that is because of information that, because of how fast information flows. Part of that is because there's very few surprises. Part of that is because they've lifted some restrictions, or they've got, some points where they stop trading. And, so they make accommodations to calm markets. However, I do think you'll see much more volatility, and you'll see a lot of selling and a lot of buying, and you will see some very dramatic dips. And the key to watch is if the market fails to make new highs and starts to make a series of lower highs and also lower lows, that would indicate that this is over. And what will happen is, as always happens, is people wait to the last minute and then they'll rush to the door, very similar to the cryptocurrencies on Wednesday or yesterday. When everybody tried to sell their Bitcoin, and of course Coinbase went down because they couldn't handle the volume. But we will trade most likely lower, and we'll go up and down, but trend lower. And then when it will end with a panic sell-off at whatever level that will be. And then we'll probably be looking for the next bull market.
Your forecast for the medium term doesn't sound so great for the risk assets. So what assets do you like right now? How would you be positioned going into the end of the year?
I'm always in equity. I'm always in equities. I do hedge them, though. I have a formula that hedges them mathematically. But listen, I'm a buyer of gold, silver, and platinum on a regular basis. I'm a big believer there. I am a buyer of cryptocurrencies as well. Not at a big level. I think that you got to make sure you understand the risk that they can go to zero, because they don't really have an underlying, and are not actually taking real delivery. But those are the places that I'm going to go. And I'm going to listen. I'm not getting out of the equity market because, again, I can protect myself, and I understand that over history there has been no greater return than the equity markets, as long as you can weather the storms when they come. And being protected and having your assets and not being over leveraged will help you do so. But again, precious metals is always a good spot to have some capital.
Okay. Excellent insights as always, Todd. It's always a pleasure to have you on the show. Thank you so much today.
Thank you very much, David. Always a pleasure to be with you, brother.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more.